Some investments grow your wealth, others just burn a hole in your future. In 2025, it's shaping up to be the year that separates the smart money from the suckers. In this video, we're digging into the worst investments you could make right now. Things that might look shiny on the surface, but underneath, they're slow-motion disasters waiting to happen. These are the traps, the trends, and the ticking time bombs you'll want to avoid. And better yet, we'll show you smarter alternatives to protect your money, grow it, and actually sleep at night. Let's get into it. First up, expensive new cars, especially luxury models. You know the drill. You walk into a dealership and there it is. That sleek SUV or glossy sports car that looks like it was made just for you. Leather seats, high-tech dashboard, custom rims. It's love at first sight. And then comes the pitch. 0% APR, low monthly payments. Invest in your lifestyle. But let's get real. Buying a brand new car in 2025 is not an investment. It's a financial black hole. The moment you drive it off the lot, you've already lost thousands in value. That $60,000 car, it's worth maybe $52,000 a week later. And in a year, try $45,000, maybe less. Especially with EV tech moving so fast, even today's high-end cars are going to feel outdated by the time you finish paying off the loan. Insurance premiums are higher, maintenance costs are rising, and if you're financing it over 5 to 7 years with interest, you're probably paying way more than you think. For what? A vehicle that depreciates faster than most people's stock portfolios crash in a bear market. Instead, think smart. If you need a car, look for a 2 to 3-year-old model that's already gone through its steepest depreciation. Or lease something with solid reliability if you value having something new. Want to go even smarter? Take what you would have spent on that luxury car and invest in an income-generating asset like a dividend ETF or a high-yield REIT, something that pays you back, not bleeds you dry. Bottom line, in 2025, a brand new luxury car is not a flex, it's a financial trap. Next up, meme coins and hype tokens. Yes, we're still doing this. Crypto isn't dead, but the days of getting rich off Doge 2.0 or Cat Coins or whatever new token is trending on Twitter, yeah, those days are long gone. In 2025, the crypto world is maturing. Regulators are cracking down. Scam tokens are multiplying. And yet, some investors are still throwing real money into coins that have zero utility, zero backing, and zero future. It's the same story every time. A flashy name, a viral meme, a few TikToks of influencers yelling to the moon, and boom, thousands of people pile in. By the time you hear about it, the early whales are already cashing out, and you're the one left holding the bag. You know, we've seen this cycle too many times. Rug pulls, pump and dumps, projects that promise to revolutionize finance and disappeared within 6 months. If you're still gambling on random tokens in 2025, understand this: it's not investing. It's playing hot potato with your bank account. What to do instead? If you believe in crypto's future, stick to the big players. Bitcoin, Ethereum, Layer 1s with actual use cases. Look into staking. Explore blockchain utility. But always do your research and never invest money you can't afford to lose. The dream of turning $500 into a Lamborghini overnight is over. And if that's still your strategy this year, your investment is probably just wishful thinking. We're only 2 in, and already you can see the pattern. It's not about avoiding risk completely. It's about avoiding the kind of risk that looks cool in the moment, but leaves you broke in the long run. Coming up, we're diving into more investment traps you'll want to steer clear of in 2025, including one that's still being pushed as passive income, even though it's bleeding investors dry. Now let's talk about vacation homes. On paper, it sounds brilliant, right? Buy a second property, rent it out short-term, earn passive income, and get a free vacation spot on the side. But in 2025, this once hot investment is starting to look like a mirage in the desert. Here's why. The short-term rental market is completely saturated. Millions of people jumped into Airbnb and Vrbo over the past few years thinking it would be a goldmine. And for a while it was. But now, cities across the US and beyond are cracking down on short-term rentals. New regulations, zoning restrictions, licensing fees. Some cities are flat out banning non-owner-occupied rentals in popular tourist areas. And even if your area is legal, you're not out of the woods. Platforms like Airbnb are flooded, guests are pickier, competition is fierce, and occupancy rates are dropping. Add on cleaning costs, taxes, unexpected repairs, HOA headaches, and vacancies during the slow season. And suddenly, your income property is more stress than it's worth. And here's the killer part. Vacation homes are often located in volatile markets, places where real estate prices swing wildly with tourism, weather, and even viral trends. That beach house you spent $800K on during the 2021 boom, it might struggle to sell for $700K now. And that's before inflation, interest rates, and maintenance eat away at your ROI. So what should you do instead? If you want to invest in real estate, go for something boring but stable. Think long-term rental properties in growing suburban areas. Or if you want true hands-off income, consider REITs, real estate investment trusts, that pay dividends and don't require you to clean up after strangers or worry about hurricane insurance. Remember, a good investment isn't about how it looks on Instagram. It's about what it does for you 5, 10, 20 years from now. And for a lot of people, that dream second home turns into a money pit with a nice view. Now let's shift gears into something even sneakier. Overpriced guru courses. You know the ones. They promise to teach you how to flip houses, build a 7-figure Shopify store, start a dropshipping empire, or master crypto trading in 30 days, all for the low price of $1,997. They flash Lamborghinis, beach villas, fake testimonials, and countdown timers to make you feel like you're just one payment away from financial freedom. But here's the truth. In 2025, most of these online courses are nothing more than glorified PDFs and recycled YouTube advice wrapped in fancy marketing. Some of these gurus have never even done the thing they're teaching. They made their money by selling the course itself, not from real investing, real business, or real success. And the worst part? They know exactly how to manipulate your fear of missing out. They target beginners, people trying to escape 9-to-5 EDs, so pay off debt or build something better. They sell hope, but they don't deliver results. Now let's be clear, not all online education is a scam. There are amazing teachers out there. But if someone is selling you the dream instead of showing you the details, run. Instead, invest in real learning. Books from reputable authors, courses from accredited institutions or real professionals with track records, mentorships with people who've walked the path and aren't just trying to sell you a funnel. Better yet, take a fraction of what you'd spend on a $2,000 course, buy $200 worth of books, and spend a month doing hands-on work. You'll learn faster, fail smarter, and lose way less money. Self-education is powerful, but only when it's rooted in reality. And finally, let's talk about buying the dip on dying businesses. This one's tricky because it feels smart. A company's stock is down 70%, and you think, wow, what a deal. Time to scoop up some shares and ride the rebound. But here's the harsh truth. Not every dip is a buying opportunity. Sometimes the dip is a cliff, and at the bottom of that cliff is a company that's about to go bankrupt. In 2025, we're seeing more and more of these so-called value traps, retail chains that haven't evolved, tech companies that burn through venture cash without finding profitability, startups that looked promising in 2021 and now can't even pay their staff. Sure, the share price is cheap, but that doesn't mean it's a bargain. It might just mean it's circling the drain. Before you ever invest in a fallen stock, ask yourself, is this company solving a real problem? Are they profitable? Or at least on the path to being so? Are the fundamentals intact? Or are you just buying the wreckage and hoping it floats? There's a difference between patience and delusion. Instead of chasing these bottom feeders, look for companies that have already proven they can adapt. The ones with strong balance sheets, loyal customers, and leaders who actually know how to run a business. Or if you want exposure without the risk of one single collapse, consider diversified ETFs that track strong sectors, not sinking ships. In 2025, bad investments don't always look bad at first glance. Sometimes they're shiny cars, or flashy coins, or a guru's secret formula for easy cash. But once you strip away the hype, the math doesn't lie. The best investors in 2025 won't be the ones chasing trends. They'll be the ones who think long-term, do their research, and understand the difference between building wealth and just spending money with better branding. So take your time, ask better questions, and invest in what actually makes your life stronger. Thanks for watching. If this helped you avoid even one financial trap, hit that like button, subscribe for more smart money content, and let us know in the comments, what investment are you avoiding this year?